Amazon reported third quarter 2023 financial results over the last couple of days, and investors were happy with the results. I happen to agree with investors. Overall, I think Amazon's third quarter was solid. A lot of good things to like from Amazon's report. One or two things that I'm a bit curious about, and I'll talk about that in this video. Overall, in this video, I'm going to go over the earnings results. I'm also going to update my recommendation of Amazon stock. 3 months ago, I upgraded Amazon stock to a buy. You're going to want to tune in to see if I'm changing that recommendation or if I'm keeping Amazon stock rated as a buy. But first, I'm going to review its earnings results. So let's jump right into those.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Starting with net sales, which increased by 13% to 143.1 billion. That was compared to 127 billion in the third quarter of 2022. These sales results were better than what management was expecting. One of the key areas I was looking out for was AWS segment sales, which increased 12% year over year to $23.1 billion. There was one specific thing I was looking for from the AWS segment, and you're going to want to wait and see what I mean by that. It was right on the borderline, and I'm going to show you what I mean a little bit later in the video. Operating income jumped to 11.2 billion in the third quarter. That was compared to just 2.5 billion in the third quarter of 2022, a nearly 5x increase in operating profitability, a huge jump, and Amazon has made significant improvements throughout 2023, improving profitability. That's one of the main reasons I upgraded Amazon stock to a buy 3 months ago, because of this progress it's making in profitability. But I also noticed something in this quarter's results that may signal some difficulty in profitability ahead. So you're going to want to watch that too. AWS segment operating income came in at $7 billion. But the important thing for Amazon stock investors is that overall operating income of 11 billion was more than AWS operating income of 7 billion. For several quarters before profitability turned around, North America segment and international segment operating were losses instead of gains. In this quarter, North America segment posted 4.3 billion in operating income. That was nice to see that it's not just AWS doing all the heavy lifting for Amazon's profitability. And again, in the third quarter, Amazon gained $1.2 billion from the change or increase in valuation in its investment in Rivian stock. Rivian had a good quarter, and so the increase in valuation in Rivian stock translated into a $1.2 billion gain for Amazon, because Amazon owns a meaningful amount of Rivian shares. Operating cash flow increased by 81% to 71.7 billion compared to 39.7 billion for the trailing 12 months in September, ending September 30th. Now, increasing your operating cash flow by 81% is impressive on its own, but it's even more impressive when you think about the gain in terms of absolute dollars. Absolute dollars. The difference between 71.7 billion and 39.7 billion. That's nearly $32 billion. In fact, exactly $32 billion of more cash flow year over year. That's remarkable. That was impressive coming out of Amazon in the third quarter. Amazon CEO Andy Jassy saying the benefits of moving from a single national fulfillment network in the US to 8 distinct regions are exceeding our most optimistic expectations, and perhaps most importantly, putting us on pace to deliver the fastest delivery speeds for Prime customers in our 29-year history. Now, that's good news for a couple of reasons. Number one, of course, it's good news that this delivery network is getting faster for customers. That's one of Amazon's primary competitive advantages, is this logistics network that it has spent hundreds of billions of dollars building out, and it's going to be very hard for any competitor to match this. even if they are willing to spend this much money, it'll be hard for them to match what Amazon has built. The other reason this is good is because I like to see when management makes a decision, those decisions work out. I like to see more of this from the companies that I would be interested in investing in, is management making decisions saying, look, we're going to do this because we think it's going to work out. We think it's going to improve profitability. And then 3 months later, 6 months later, or 12 months or 2 years later, I want to see management come back and report to shareholders and say, look, we said we were going to do this and it was going to improve profitability. Turns out it's even better than we thought. So it worked out even better than we thought. That's what I like to hear. That's where I want to invest in. That's the kind of management teams I want to invest in that are making decisions that are working out. So often I see management teams saying, well, we made this investment, turns out this happened and that happened, and they start making all of these excuses about why it didn't work out and why they need to cut their losses and say we made a mistake, it's going to cost us a couple of $1 billion and we're going to exit that decision. So I don't like to see that. I like to see more of this, more of what Amazon is doing here and saying, look, we made this decision, it turns out better than expected. So awesome. I like to see this. It increases my confidence in the management team. And of course, the most popular investing theme in 2023 is artificial intelligence. Amazon does not want to be left behind in this, and it's been investing aggressively here. And it entered a strategic collaboration to advance generative AI with Anthropic. As part of the expanded deal, Anthropic selected AWS as its primary cloud provider and will build and deploy their future generations of its foundation models on the AWS Trainium and AWS Inferentia chips. So Amazon building its own chips, partnering with this company in a similar way that Microsoft partnered with OpenAI's ChatGPT, which runs on Microsoft's cloud. Um, Anthropic's AI will run on Amazon's cloud. So an interesting partnership. It remains to be seen how this will all work out, but it's good to see Amazon participating in this. And from what I've heard so far, Amazon's chips or Amazon's AI chips are delivering excellent price performance, relatively speaking, with the price compared to the value it provides. So it's competitive, and CEO saying that it's available too. Nvidia is having a difficult time ramping up production to fulfill the needs from its customers, the demands from its customers. Amazon, meanwhile, saying, we've got enough production, we've got enough supply. So if you're interested, you could come to us for our AI chips. Okay, so now we get to the part that I wasn't too thrilled about with Amazon, and that was that it announced it will hire 250,000 full-time, part-time, and seasonal employees in the US for the holiday season. It also announced the largest ever annual investment in US hourly employees of $1.3 billion, bringing the the new average hourly wage for fulfillment and delivery roles to more than $20.50 per hour. That's a lot for your warehouse and delivery employees to earn, especially when you consider how many people Amazon employs. I was hoping that Amazon had enough employees to grow into, and that's certainly the trend that we were seeing from Amazon. So this announcement that they need to hire more employees to deal with the increase in demand during the holiday season, I was a little disappointed with, because I was hoping they had enough people to handle this. I was hoping that the current staff was enough, because remember, during the pandemic, management said that they overhired, they overinvested. And so for 2023, they've been growing into that investment, and that's partly why they've been making those big gains in profitability, because they already had that infrastructure in place, and all this revenue was letting them grow into that increased infrastructure. And so now what they're saying that they need to hire more people, it leads me to believe that they've done all that growth already, that all that they can grow with the existing staff that they have, meaning if they need more growth from here on out, they're going to need to hire more employees. So I'll talk a little bit more about this, but this is one of the things that I was a little bit disappointed to see. I was hoping to see Amazon continue to grow without needing to hire more people. Okay, moving on to guidance. For the fourth quarter, Amazon is guiding between 160 billion to 167 billion, or to grow between 7% and 12% compared with the fourth quarter of 2022. At the midpoint, this would be about 9.5% rate of growth, which would be a slowdown from the third quarter. Wall Street was expecting a little bit better from Amazon in terms of revenue growth in the fourth quarter. Nevertheless, here it is. That's the midpoint of the guidance, 163 billion. Wall Street was around 166 billion at the midpoint for expectations for the fourth quarter. Operating income is expected to be between 7 billion and 11 billion, a midpoint of 9 billion, compared with 2.7 billion in the fourth quarter of 2022. So if it hits the midpoint of this target, it would be about triple the operating income it generated in the fourth quarter of 2022. It would be impressive growth to be sure. However, it would be a slowdown from the rate of profitability growth in the third quarter. Remember, in the third quarter, they grew operating income by nearly 5x. And so it would be a slowdown from that higher rate of growth. Regardless, impressive to be sure, increasing or more than tripling your operating income. So earlier I talked about how Amazon overinvested during the pandemic and now it's kind of growing into that. We kind of see a continuation of that trend if you look at Amazon's purchases of property and equipment, which is a sort of proxy for its investment in things like warehouses, planes, trucks, delivery vans, and things like that. It's logistics infrastructure. And you can see in the 3 months ended September 30th, they decreased their spending on property and equipment from 16.378 billion down to 12.479 billion. So a decrease of about $4 billion year over year, or about 25% decrease in spending on property and equipment in the most recent quarter. For the 9 months ended September 30th, so far in 2023, that spending is down by about 9 billion from 47 billion last year down to 38 billion this year. So this is partly a continuation of that story I've been liking about Amazon, is that they're growing into their existing investment and they're not needing to increase their purchases of property and equipment as much as in prior years. And earlier in the year, Amazon said most of this spending in capital investment for 2023 will be in building out its data services, its cloud servers, and building out for AWS, Amazon Web Services, not the retail side of the business, not the logistics network. So I like what I'm seeing here. I hope this trend continues for Amazon in reduced capital investment and growing into their existing capital base. And continuing with the impressive theme from Amazon in the third quarter, Amazon generates sales from products and services. I like to see more growth from the services segment because the services segment is way more profitable than the product segment. And that's precisely what we saw in services sales, growing by more than 12 billion year over year from 67 to 79.9 billion, where the product sales category grew by 4 billion. So the vast majority of the growth in Amazon's most recent quarter came from the services segment. I really like that. I want to see continuation of that from Amazon. Also, Amazon actually delivered this kind of impressive double-digit growth in the quarter while simultaneously decreasing their spending on sales and marketing from 11 billion to 10.55 billion. That's solid as well. A lot of times you see companies generate top line revenue growth just by increasing their spending on sales and marketing way more than their revenue growth is. So they're inefficiently growing their revenue. That wasn't the case for Amazon in this quarter. They also decreased their spending in general and admin from 3 billion down to 2.561 billion. Remember earlier in the year, Amazon announced layoffs of thousands of employees, and so that's starting to pay dividends in reduced spending in these two categories. Another dominant investing theme in 2023 has been the macroeconomic environment, namely the rise in interest rates they've gone from close to 0% in early 2022 up to about 5.5% as of this recording. So I like to see companies opportunistically paying down some of their debt so that they don't have to pay those higher interest expenses. And Amazon has done that, lowering their long-term debt from 67.1 billion down to 61 billion, or in other words, paying down $6 billion in debt between December of 2022 and September 30th. So bringing down their balance by 6 billion, which is solid because if you think about $6 billion at 5% annual interest, at least they have to pay 5%. So that would be about 300 million per year. Now I know they may have gotten these loans earlier when interest rates were lower, but now as these loans come due and they choose to either pay it off or refinance, if they choose to refinance, they're going to pay at least 5% because you got to pay, as a corporation, you've got to pay at least what the government bond interest rate is, plus a risk premium above that. So Amazon not likely to be able to borrow even at 5% if they were to borrow today. They would have to pay at least 5% plus a risk premium above that. Because investors would say, well, if I'm going to only get 5% interest, why wouldn't I just invest in a government bond, which is arguably safer, which is safer than a corporate bond. So if I'm going to invest in a corporate bond, I need at least 1 or 2 percentage points higher. And so $6 billion at least 5% is $300 million per year. Amazon reducing that by paying down the debt. That's going to be positive for profitability. Okay, a few more solid improvements from Amazon in the third quarter. Number one, the operating profit margin for the North America segment. I've highlighted that here. In the most recent quarter, 4.9%. And look at this improving trend for 1, 2, 3, 4, 5 consecutive quarters, starting with negative 0.8% in the second quarter of 2022 to negative 0.5% to negative 0.3% to 1.2%, 3.9%, and now 4.9%. Steady and solid, consistent improvement from Amazon in this segment, growing into the overinvestment it committed in the early stages of the pandemic. Great to see this, and it turns into $4.3 billion in operating income for Amazon from this segment. Similar story for its international segment, although not yet positive. It is improving from negative 8.9% to negative 6.5% to negative 4.3% to negative 3%, all the way down to negative 0.3%. If this trend continues, I wouldn't be surprised if in the next quarter this segment was profitable. And finally, here's the AWS segment. And remember I said there was an interesting thing I was looking for from the AWS segment and how it came in just on the line, where this is what I mean. Look at the AWS segment net sales growth going from 33 to 28% to 20% to 16% to 12%. That's 1, 2, 3, 4 straight quarters of consecutive decline. So coming into this quarter, the one thing I was highlighting was I wanted to see that decline turn around. I wanted to see an end to that declining growth rate from the AWS segment. And what did Amazon do? They came right on the line at 12%. So in a way, they stopped the decline, so it's not falling anymore. It flatlined. I would have liked to have seen an uptick, but a flat line is okay. Now, the next quarter, I'm going to be watching this segment again closely, hoping for an uptick or, again, another flat line of 12%. What I would not want to see is another decline in this segment because it's so important to Amazon. We see here it generated nearly over 50% of the operating income for the company, generating $7 billion in operating income. The positive thing about this 12%, even though it was flat from the previous quarter, look at the difference in operating profit margin. In the previous quarter, it was only 24.2%. That jumped to 30.3% in the current quarter. So it's a different kind of 12%. It's a more impressive 12% because it's 12% revenue growth with 30% operating profit margin. That's considerably more impressive because that means Amazon probably didn't offer that many incentives or discounts to secure these deals, to secure this revenue. That makes it even better than it is on the surface. And another segment that's proving to be valuable for Amazon is the building advertising business. That's grown for over 20% for 6 consecutive quarters. In the most recent quarter, it accelerated to 25% growth and generated 12 billion in revenue. Amazon is building a respectable advertising business, and remember, ad sales are a lucrative business. They are profitable, and you can compare the profit margins generated by Meta Platforms and Alphabet to see just how profitable the advertising business is. So this is good news for Amazon stock investors as well. Okay, the other area that I was a little bit disappointed with from Amazon is the employee growth, like I kind of talked about earlier. I was seeing very nice trends here where 1, 2, 3 quarters in a row, employment was decreasing from 1.544 million people down to 1.541 million people to 1.465 million people to 1.461 million people. And I was hoping to see a steady, continuous decline here as people quit. I wanted Amazon not to hire back as many people and let this employee count drift downward through attrition, but I was disappointed to see an upward tick here going from 1.461 million to 1.5 million, and I wouldn't be surprised if in the fourth quarter this rises even higher because of that announcement when they said they're going to hire 250,000 seasonal employees. And so you could see that already translating into rising shipping costs year over year, growing 9% year over year, and paid units also growing 9%. This has accelerated for a few straight quarters after it was falling from 10%, 4%, 2%. It turned back upward 6%, 9%, and I wouldn't be surprised if the fourth quarter is another uptick in the rise in shipping costs because of the increase in wages and the increased number of people they're hiring. All right, so to answer the question, is Amazon stock a buy, a sell, or a hold? Am I changing my recommendation? Remember, I came into this quarter recommending Amazon stock as a buy, and I'm keeping that recommendation. I'm saying Amazon stock is still a buy. What I have here is Amazon's PEG ratio, the price to earnings ratio divided by the growth in earnings, and that's come in at 0.72. Typically, a PEG ratio of less than 1 is an indicator of good value from the investor perspective. So Amazon stock, according to this ratio, is not expensive. And given the excellent progress the company is making, its competitive advantages, the management getting better at running the business after the disruptions of the pandemic, I would say Amazon stock is still an excellent stock to buy right now. But before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching.